As part of a series, I like to share with investors some of the more fascinating interviews I've conducted over the past few months. Recently, I had the chance to visit with Frank Holmes, CEO of US Global. Here are some excerpts from that insightful conversation. Frank, you recently went to India. What did you see when you went there?
What did I see in India? Robust activity everywhere. It's amazing to see that even going to the low-end gold jewelry manufacturers and distributors, they're paying over $1,600 an ounce for gold. So there's still a demand. I know that the government's doing everything to try to curtail, but I think what the big factor here to pay attention to is that now the Indian government doesn't have to report gold into the country, so therefore it doesn't show up as negative to their current account, even if the gold is coming in the country.
Yeah.
So I think that's an important factor. One thing I did see is the GDP per capita, I think, will start to rise in India, and that's very important for that love trade, that consumption of gold.
What was your biggest takeaway as far as opportunities?
Well, when you look at resources, it's not so much directly with resources. The GDP numbers, when you compare China and India, they're very different. But what you do see is this push for the subway system, a push for infrastructure building. And as long as that's maintained, then that level of spending and focus, then you're going to see a continuous, I guess I would say, demand for a lot of the commodities. I think that that's what's positive. But for consumer products, when you take a look at FDA-approved clinics, there are more FDA-approved clinics doing research in India than there are in America. And all these companies are run by PhDs who earn their PhD in America. They've gone back to India, and their expectations are America. Higher standards of I would call it accountability, meritocracy, not a caste system. So those things, I think, long-term are very constructive and positive.
So let's talk about gold. What's your outlook for gold for the remainder of 2014?
Well, gold has been incredibly disappointing, and I can understand why. Because I always talk about this love trade, and the GDP per capita slowed down in India, and China's now just starting to turn back up. So I think that's probably better. But I think then on the fear cycle is that actually all this money that's been going into the system has not been showing up in loans. So what they call money velocity has actually not been rising. And that's one reason why you see the CPI numbers fall. This past year we had CPI numbers fall in the US, and we had the 10-year, 5-year, and 30-year rates start to rise. So you went to a positive real rate of return. Now, whenever you have where investors make money on treasury bills in particular, that's more than 2%, gold has never been attractive as an asset class for money, attractive for jewelry. But whenever you have negative real interest rates, the government is going to pay you to lose money, gold starts to take off. And since 2001 until this year, you've predominantly had a negative interest rate cycle. So with that, when I put that all in context, and I look at big picture in 3 decades, this is the 3rd time we've seen this. It happens every 10 years where gold stocks, not gold, but gold stocks fall for 3 years in a row. It's never happened for 4th year. And I would feel that much more comfortable. I took a look at, I call the elasticity and models, et cetera, that we use, that gold is due for a substantial rally, which could be 30% for gold. It could be 60% for gold stocks.
Frank, you also mentioned economic indicators. Maybe you can elaborate on PMIs.
PMI, Purchasing Manufacturers Index. It's one of the most important indexes that politicians track, because it's highly correlated to manufacturing jobs, which have a much higher salary worker. And that's important in that whole process for getting a pulse on job creation. So last year we saw in the US, the purchasing manufacturers, which they call in the US a different name, it's ISM, same thing. And the ISM in the US, it had turned positive. And guess what? Boeing was up almost 90% last year, manufacturing aircrafts. And you're seeing airline stocks also were up dramatically last year as they've rationalized flights that are available. They've increased the prices, and now they have spending power to buy new jets.
Yep.
Well, that has this whole power of this PMI. And what we've seen in our research is that it's important to follow global PMI, which JP Morgan publishes.
So at US Global, help us understand what you track.
We track all the G7 countries and E7 countries, but one of the interesting for simple math is that whenever the global PMI is positive, and I mean positive, that is the 1 month data is higher than the 3 months, and the 1 month data is higher than the 12 months. So it means you have either a secular rising market and demand for job creation, which uses metals. They use oil to manufacture any product, is highly intense with energy and metal consumption. So that's why it's highly correlated to resources. And what happens is whenever that PMI turns positive, within 6 months you see energy prices rising. Energy stocks, there's an 80% probability rising. There's almost a 78% probability of copper rising. So when I go through all the commodities, I can go back over 20 years, 30 years of data, and I can create a probability model with it. And it's powerful that when they said they're going to pull away the punching ball last May, all the PMI started turning positive. So with that, you saw a snapback up in a lot of the commodities. Sell off out of fear, creating some spectacular buying opportunity. And guess what? Most people are underinvested resources and energy, and then the S&P index of 500, the biggest market cap companies, has 10 sectors. Basic materials and energy are about 13% of the overall economy of America. They were up 25%. That's just a huge win when everyone says how bad commodities are.
And any final words of advice for investors that tune in today?
Be diversified. Just appreciate the seasonality and the volatility of all these different asset classes. The DNA of gold over any rolling 12 months is plus or minus 15%. Gold stocks, plus or minus 35%. So anytime gold stocks fall 35%, it's become an opportunity to buy. When they fall 60 and 70%, it's a screaming buy. And they will rally and they will rise. And the same thing with other asset classes. The S&P, 70% of the time it goes plus or minus 20%. Anytime it goes up 40%, you've got to take profits. So the only way to have that discipline, because we have these emotions that take over, the DNA of greed and fear. They call that your reptilian mind, fight or flight. When you discipline yourself that you're going to have 10% in gold and you're going to have 80% in gold stocks, 10% in gold, and you can have 80% in the S&P 500 type companies or Canadian big blue chip companies, and the remaining 10% are more speculative stocks, etc. And you rebalance that, you do spectacularly well, but you must have a mechanism that says, I will rebalance. So one of the things we try to urge investors is that whatever your age is that is the amount you should have in equities. And as you get older, you should shrink back. So if you're 60 years old, it should be 60% short-term debt or high dividend-paying stocks. Not the inverse, and most people flip that over. So that diversification is the biggest thing I can share with all your listeners.
Great, thank you so much.